Welcome to the Deep Dive. This conversation is part of the Journey series by ACE, a cross-border boutique investment bank centered around a global investor business owner network. Today, we're diving into something really critical for any private company owner or investor, the art and science of the investment exit strategy. For many founders, an exit isn't just a transaction. It's often the moment, maybe a once-in-a-lifetime chance to unlock serious wealth. We're talking potentially more than 10 years of profit distribution all at once.
And that's exactly why the stakes are, well, incredibly high. It's genuinely painful to see founders who've poured everything into their companies, sometimes for decades, and then they can't actually enjoy that potential wealth or secure their legacy because the exit wasn't planned properly. Not all exits work out. Some can even backfire badly.
Absolutely. So our mission for you today is to unpack the key elements you need to capture the biggest value possible. And, crucially, help you avoid those common pitfalls during your next exit event. We're drawing insights from the ACE Navigator source material here. Okay, let's get into it. The word exit. It can sometimes make people nervous, right? Internal teams, external partners, before anyone even breathes a word about selling. What needs to be formulated? What's the groundwork?
That's a really crucial starting point. Like, an investment exit isn't just selling out. Think of it more like a strategic recapitalization. It's when shareholders sell shares after the company hits, attractive strategic or financial milestones. The ACE Navigator really emphasizes this. You absolutely need a clear, well-thought-out exit strategy before anything goes public. This strategy needs to cover company readiness, future potential, what happens to stakeholders, and, importantly, the right kind of new investors. Without that plan, just announcing an exit can cause unnecessary worry and maybe even hurt the value.
Right. So it's about the narrative, the story you tell. An exit might not be the best first word to use. It's more like a planned transition, a new chapter, not just walking away. Okay, this is where it gets really interesting for me. What actually makes a company truly attractive for an exit? The kind that gets that premium price. Right. What does that company look like?
Fundamentally, it boils down to readiness and future potential. Investors putting in serious capital want a company that's primed for faster growth, the ones commanding a premium. They're the companies where owners have methodically built them to advance milestones, strategically and financially. Think of it like a well-oiled machine ready for more fuel. It makes it much easier for new investors to step in and accelerate things. Early-stage companies without those proven milestones, well, they just won't command that premium. They haven't built that verifiable value yet. Actually, the ACE Navigator points out something interesting: company culture. It's often overlooked, but can add millions to valuation, reassuring buyers about smooth integration.
That makes a lot of sense, demonstrating a track record and a clear path forward. But even for those really attractive companies, what other factors, sort of bigger picture things, help fine-tune the best exit scenario? It's not just the company itself, is it?
Exactly. Internal readiness is key, but you also have to assess the wider environment. Economic cycles, for instance, recession versus boom. Interest rates changing, they impact valuations, availability of capital. Then there are industry cycles, shifts in, say, consumer behavior, new tech disruptions, competition, supply chains. And finally, the company's own specific stage is vital. Is it pre-revenue? Growing fast, mature, maybe declining, its size, financial health, the current shareholder setup, the management team's strength. All these details matter for figuring out the optimal path.
Okay, so assuming a company is ready and these external factors are considered, the big question is, who actually buys these shares in these big exit events, and how are the deals actually structured?
All right, this is where the strategy really comes into play. You've got a few main types of buyers. First, private equity funds. These are sophisticated folks pooling money to buy companies, often aiming to optimize and sell later. They usually bring operational know-how. Then you have strategic investors. These are typically players in the same industry buying for things like market share, tech, or synergy.
Okay.
A third group, pre-IPO investors. They buy private shares in companies nearing an IPO, hold for a bit, hoping for a premium when it lists. And finally, the IPO markets themselves. That's usually the latest stage, aiming for a big premium. Choosing which market to list on is a strategic call, too.
And does ACE have a preference?
Yes.
Is there an ideal partner profile?
Yeah. At ACE, we tend to favor sophisticated funds, PE, or strategic, with solid track records not just in investing, but in successful exits. These groups often show long-term interest, understand the full growth cycle, and care about preserving legacies. We strongly advise against selling to parties who might just break up the company. That sends a really bad signal, honestly. A truly successful cycle ends with passing the torch to investors who can take it to the next stage.
That's a key point, preserving the legacy, ensuring continuity. It's not just about the money. So, beyond who buys, what forms can these deals actually take? It's not one size fits all, right?
Not at all. Deals can be structured in various ways. The simplest is a full buyout 100% sale, common with strategics. Then there's a majority buyout.
Okay.
Sell most shares, keep a minority stake, often used when the sellers need to stick around for a smooth handover, maybe in stages. Another popular one, especially with PE, is a mix of capital raise and buyout. Some money goes to the sellers, but a good chunk goes into the company for growth. This really aligns interests. It shows the original owners are still committed, which often attracts more capital for everyone.
That makes sense.
And finally, a partial buyout. Owners don't sell a majority, but bring in other investors. The fascinating part is how you can combine these options. It's all down to analysis and negotiation. Very flexible.
This brings up a really important point. Beyond the numbers and legal stuff, who are the people making this exit decision? What drives them?
The human element, absolutely critical. Understanding shareholder profiles and motives lets us tailor the best exit scenario. Popular topics, personal plans, company legacy, the team's future. You see different types. Founders who built it up, or maybe early acquirers, some succeeded, want a high price, others struggled, might take less to just move on. Inheritors, maybe second gen, who aren't passionate about running this business. Wealth-focused individuals wanting to enjoy life, do philanthropy, maybe buy legacy trophies.
Right, not always just about the maximum cash.
Sure.
Passion, new challenges.
Exactly. You get challenge seekers who love the early risk, build it, then sell when it's stable to find the next adventure. Or engineer scientists who love inventing but hate managing big teams. Selling lets them get back to R&D. And recyclers, savvy types, liquidating one position to jump into another higher upside opportunity. These personal goals, legacy, employee futures, they often weigh heavier than pure financials.
Okay, finally, let's talk about avoiding the nightmare. A failed exit. Or worse, one that backfires. What are the big red flags, the signs that say, stop, rethink this?
Recognizing these early is crucial. If you see them, pause, get advice. One huge sign, owners rushing to exit. A sudden push often signals hidden problems or no succession plan. A truly valuable company isn't sold in a panic. Buyers smell desperation.
Yeah, that makes sense. Rushing signals weakness. What else?
Extreme valuation expectations. Either way too high, which scares off smart investors, or way too low, which just leaves money on the table, shows poor analysis. Also, the absence of clear, long-term strategic plans. It signals a company isn't ready for sustained growth. Relationships might be short-term focused. Big problem unless new investors want a major overhaul.
So lack of future vision, maybe messy internals.
Precisely. And that leads to poor records and documentation. Even a great business looks bad if the books are a mess. Sophisticated buyers need clean, transparent data. Then there's waiting too long, especially after inheritance. If the company drifts without active management, it just becomes less attractive over time. And finally, shareholder structure problems, conflicts, different motives. These blow up during an exit. Best to sort out the cap table early on before success makes it more complicated.
Wow, quite the deep dive indeed. We've covered the huge potential value of a well-planned exit. What makes a company attractive, the buyers, the deal structures, the vital human element, and those critical pitfalls to avoid.
Absolutely. And this isn't just for people selling now. Understanding this stuff helps anyone involved in a private company think strategically about building value for the long haul.
So here's a final thought for you, our listener. Knowing all these crucial elements, readiness, deal structures, motives, pitfalls, how does this change your perspective on your current ventures, or even future investments you might consider, long before an exit is even on the immediate horizon?